Hi, digital marketers in the insurance industry. My name is Ferdie. Today I want to talk about mastering P-factor bidding. So in the competitive industry of insurance, P-factor is incredibly important. It's called also known as profitability factor. And it is basically the difference between having a sustainable marketing campaign and not having one. This is a really critical thing if you want to compete in the space. So let's unpack what the P factor is. You take the acquisition cost. So this is the cost to sign a customer. So this is usually the advertising cost or the marketing cost. You can add the call center cost in there as well. And you divide it by 1 month's premium. Every client has got a different definition of the acquisition cost. You need to decide what yours is. So if, for example, you pay $1,000 to get a client, and the acquisition cost to sign the customer is $200, it means that the P factor is 5. So you take the $1,000 divided by the 200, you get the number 5. So in the industry, like 5 is considered to be good. If, for example, it's higher, like let's say it's 12, I would state it's quite aggressive. I wouldn't say it's bad. If you're a new insurance provider, you need to get into the market and to build a book. So, more established insurance brands wants a lower P factor than a high one, but this is how it's calculated. So Google Ads doesn't have P factor bidding inside it, but its definition or the functionality that you can use for P factor is what they call return on ad spend. So it's the ROAS. And how that is expressed is revenue divided by cost. So if you take 1 month's premium and you divide it by the acquisition cost, and in this instance it's the $200 divided by $1,000, you get a percentage, and in this instance it's 20%. So a P factor of 5 is, if you recalculate it from Google's perspective, the ROAS that you need for P factor of 5 is 20%. Now, for the smart math people in the call, it's the inverse of the P factor. So what we want is we want 20% return on investment. So let's talk about how to actually do this. So Google can go and try and hit this ROAS target, this P factor target of yours. All that it needs is the 1 month's premium sales information. So it needs that revenue, the premium value for it to go and try and hit that 20% ROAS for you. So let's talk about how do we send the sales data back to Google Ads. So for this to work, you need to link when the person has clicked on the ad, they went to your website, they completed the lead form or the quote form, and when they enter your CRM system and where the sale actually happens. So you need to link this journey that a client takes. So there's basically 2 things that you need to do. So one is you need to parse the 1 month's premium information. So if for example there's an indicative quote on the website, you need to capture that in your CRM system, or if the sale happens in CRM, so that needs to be parsed. But you also need to parse what they call the Google Click ID. So this is the unique identifier to link the person from the ad to the website into your CRM. So you need to pass that information along. The way to do that is usually with a hidden field. So if you have a form, you need to populate 2 hidden fields, one with a month's premium, one with a G-Click ID, and that needs to be passed along to your CRM. To show you what it looks like is if you go into into Chrome, you can look at the cookie information on your machine, and there's a little identifier. I've highlighted it on the screen. So that's the unique code that Google needs to identify the visitor. It needs to then be passed to your CRM system. It doesn't matter which one you have. Most clients use Microsoft Dynamics. It could also be Salesforce or HubSpot. Once it's captured inside CRM and the sale has happened, you need to pass that information back. The format of this is in a CSV that you need to export. new, and it needs to include the premium amount, but also the client ID. In the end, what it is going to look like is you have the form. We start on the left-hand side, fill out the form. It goes to the CRM system. It goes into Google Analytics, and then you pass it on to Google Ads. So this is the information that you need to pass to Google Ads to enable ROAS-based bidding. So going back to the previous slide, in this instance, we set a P factor of 5, which translates to a 20% ROAS. And then what we need to do is go into Google Ads and go and set that 20%. So there's a bidding functionality inside Google Ads that you can set the target ROAS, so that it's currently set to 100. So you need to go and set 20% there. And if you click Save, Google will then try and go and get clients that's similar to the one that's signed, that equated to a P factor of 5. So this is, and what Google will then do is it'll go and look for those customers, and it'll automate the bidding, the penning, and making sure that you hit the P factor of 5. If you are in a very competitive industry, there may not be enough customers that you can acquire a P of 5. Then you need to move it up slightly to a 6 or 7 and see if you get volume. And this is basically how it is. I would recommend, after you've set it, give it a couple of days to run, possibly a week or 2, so that the data can come in to see if it's working, because it's learning what to bid. And just keep your eye on it and see if it works for you. So if you have any questions, please reach out. I've got the URL there. And please also, if you like the video, click subscribe, click like, and good luck. And let us know if this was valuable for you. Thank you.